Hello, everyone, and welcome to MSUFCU's Financial Education Seminar Series. We appreciate you all joining us and are excited to be here with you virtually. These presentations were created with you in mind, with the intention to give financial education on a number of relatable topics to help expand your knowledge of finances. Each event will be hosted by a member of our financial education department or by one of our partners, connecting you with resources in our community. We have a number of diverse presentations planned for you this year, and you can explore and register for them by visiting us at msufcu.org/events. Today's event is being recorded. You can rewatch or share other presentations that we have on our YouTube channel by going to youtube.com/MSUFCU and then selecting the seminar series from the playlist options. We will have time after the presentation to address any questions submitted through the Q&A. You can send your inquiries at any time, which will later be answered in the order that they were received. My name is Therese Bacon, and I'll be your facilitator this afternoon. If you have any technical issues, you can go ahead and chat me directly in the chat, and I can try to assist you through there. And then I'll go ahead and introduce our guest today. So we have an amazing guest joining us to help us learn how to maximize our tax savings in retirement. So allow me to introduce our host, Rianne Horgan, the CEO of Silver. Rianne worked for 17 years at JP Morgan, where she advised individuals and families on investments, credit, and wealth planning. Recognizing there was a need for further education, she then founded Silver to provide members like you with retirement calculators, tools, and education through their platform, Retirement Simplified. We're excited to have you here with us today, Rianne, and help us learn about some of these updates and tax tips that will help us get organized for the upcoming tax season. So I'll go ahead and turn it over to you to start our educational journey this afternoon.
All right, Therese. Well, thanks so much for inviting us today and for all the MSUFCU members. It's a pleasure to be with you. First of all, Happy New Year. I know New Year's comes with lots of New Year's resolutions and often tends to be the biggest time of year where folks are thinking about financial planning. And so hopefully as we go through the session today, there'll be a couple of things that you can pick up that will be new that will make sure that your hard-earned savings are staying with you for your retirement. So today the topic is going to be maximizing your tax savings in retirement. We're going to talk a lot about kind of how to maximize how much you can save on a tax deferred basis, but also how to get that money back out in retirement. We're going to cover a lot of different topics. I did want to just flag that not only will there be a replay of the webinar, but we also have all this information online at msufcu.silver.com. After the webinar, you can create your profile and you'll be able to access all this information. Let's kick off. I want to just give you a little bit of background on Silver, just so that you kind of understand the context that we're coming from. Our platform is really designed to help members over the age of 50 navigate all the big decisions you make in retirement, Social Security, Medicare, taxes, spending. We know it is complicated, and our goal is to make it a little bit easier for you to put that full picture together and feel confident about the decisions that you're going to make around retirement. At the heart of what we do is we provide members with a retirement score. You can think about this like a FICO, but for retirement. It helps you understand how long your savings are going to last in retirement, which I know is, for folks who don't have pensions, is one of the big concerns in retirement. In addition to a set of tools and calculators, we also have a lot of education that's pretty timely. So again, lots of 3 to 5 minute lessons on Medicare, Social Security, taxes. Our goal is to not only give you that foundational education that you need to help you prepare, for example, to enroll in Medicare, but also keep you up to date. As the new administration comes in next week, we're expecting a lot of changes to Social Security and Medicare, and the goal through the platform is to make sure that we're keeping you up to date as changes happen. So I think for those of you that are either planning for retirement or in the early days of retirement, know that it's a fairly complex web of decisions that you have to make to really kind of move into this kind of next phase of life. Whether it's Medicare or Social Security or thinking about your savings, in many ways, all of these are touched by taxes. And so today what we're going to do is we're going to unpack some of these topics, make sure that kind of we're clear on some of the foundational items that really matter as we set you up to keep as much of that savings for yourself rather than Uncle Sam during retirement. So the topics we're going to cover today, we're going to just talk a little bit about contributions. We'll talk a little bit about what changes every year, so you have the context on how some of these numbers do change. We'll talk about what are called required minimum distributions. What I would just generally say here is that if you have tax deferred savings accounts, at some point the government wants their taxes. And so we'll talk about when you have to take money out. We hear a lot of folks really thinking about Roth conversions, so we'll talk a little bit about what those look like, some of the evergreen topics around estate planning and gifting, and then perhaps a topic that might feel a little bit out of place, but I think is really important is retirement health care. We'll talk about kind of what it costs, but also some of the tax implications, decisions you might be making from a tax perspective that could actually impact your healthcare costs. So those are the main topics we're going to cover today. We will have a Q&A at the end. So I would say that if you have questions as we're going through, please just drop those questions into the Q&A and we will make sure that we answer them live at the end. All right, so let's start with just kind of the general maximizing the after-tax savings in retirement. I think folks are probably aware, of the kind of the main kind of savings programs, whether it's 401ks, 403bs, IRAs. I think for those of you on the phone, the most important thing to be thinking about is that there are these catch-up contributions that start at age 50. So if you're over the age of 50, you have the ability to increase what you're contributing to your 401k, 403b, and IRA. We'll talk a little bit about what the full limits are, but just kind of keep that in mind that you're at this point that as you're preparing for retirement, that you have that additional amount that you can put in. That impacts not only 401ks and IRAs, but it also impacts health savings accounts. And for those of you that are eligible for health savings accounts, I think health savings accounts are probably one of the most underutilized savings accounts in America. They also have catch-up contributions, but what's really beautiful about HSAs is that you have the ability actually to withdraw the funds fully tax-free for medical expenses in retirement. We'll talk more about this later, but the reality is there are a fair number of out-of-pocket costs for healthcare and retirement. So having an HSA to help cover some of those costs can be a really interesting saving strategy. Probably I would say for everyone, but if anyone is in the fortunate position to have maxed out their 401k or IRA contributions, it's a really good strategy to be considering as an additional tax-deferred savings strategy. So the first thing I wanted just to flag, particularly as it's January, folks may be starting to get some of their tax packets together. As you start thinking about the April 15th federal tax deadline, is that the numbers do change every year, and so I just have one example here that shows that the tax brackets adjust every single year, and they adjust based on inflation. And so when you actually look at what's happening every year when the government updates their numbers at the end of the year, they actually update not the rates, but the actual brackets. And so, between 2024 and 2025, that upper bracket for a single individual at the 22% rate has actually increased by about $2,800. So something just to be thinking about for those of you that are looking at your tax bracket is you might be able to earn a little bit more in a lower tax bracket because those tax brackets are being adjusted on an annual basis. We don't see as much of those inflation adjustments happening on the state level, but definitely see it kind of on an annual basis on the federal level. The other thing that we see being adjusted every year are the contribution limits. And so when you just look at this past year, what we saw was that the 401k contributions went up by $500. The 401k catch-up contributions didn't actually change, but the actual max on kind of pre-catch-up contributions did increase by $500. Again, the government every year kind of with inflation trying to give you a little bit more space if you have that ability to max out those contributions. Similar to 401ks, sometimes we see changes on the IRA contribution as far as the caps. This past year, we did not see any changes to those caps, but so something just to be aware of is that we saw the changes to the caps on the 401ks, but not on the IRA contribution limits. If you are still, I guess I would say is whether you're working or not, one thing just to keep in mind that is that under the Secure Act 2.0, you are still able to continue making contributions to traditional and Roth IRA accounts, even if you're retired. So again, just thinking about kind of what your cash flow looks like, what you're looking to put aside from a savings perspective. There may be continued opportunities to get that kind of tax deferred compounding on your savings. All right, let's talk about required minimum distributions, and maybe we'll just start with kind of the big question of what is required minimum distributions. And what I would just say to you is, for those of you that have 401ks, 403bs, IRAs, what you'll know is that you're putting pre-tax money into those savings accounts. And at some point in time, the government says, well, you need to start taking that money out of those accounts, because otherwise those accounts are kind of a permanent tax shelter. And so what we see with the RMDs is that every year, starting at the age of 73 today, you need to start taking money out of those accounts. The percent changes every year based on your age. So this is where the government does not make it easy. There's not one like take 4% out every single year. There's actually a table that based on your age, there's a different percent to take out. It starts at about 4%. So it's 3.77% you take out at age 73. And it's based on your 1231 balance. And so for those of you that are in a kind of RMD phase right now, what you'll notice is that your RMDs are going to be probably higher this year than they were last year. The reason they would be higher this year than last year is because we saw a pretty significant rally in the market. And so if your 401k or IRA, for example, is invested in stocks, you likely saw those balances increase last year. And that likely means that the dollar amount you have to take out of your account to meet your RMD obligation will increase. So a really important thing to be checking every single year is, what is your RMD? You get statements from your financial provider that tells you kind of the balances and what the amount is, but important to kind of keep on top of. Not all accounts are subject to RMDs. So the accounts that are subject to RMDs are accounts like IRAs, SEPs, traditional 401ks, 403bs. The number one account that isn't subject to an RMD is a Roth. And we'll talk a little bit about Roth conversions. One of the main reasons folks think about Roth conversions is because it has the ability, it doesn't force you to take the RMDs. Accounts like health savings accounts also not subject to RMDs. Important if you are married or in a household with more than one person, to know that you cannot merge your accounts. Your retirement savings accounts are individual accounts, and you actually have to calculate your RMDs individually. So as an example, my husband and I, like, we each have to take RMDs out when we turn 73 from our individual accounts. We can't take all the money out of one, like his account, let's say, and leave the savings in my account. So important that you're doing those calculations on an account by account basis. You can combine, like if I have one IRA and 3 401ks, I can combine it under my name and take that full obligation out of one account, but I can't, again, kind of cross-pollinate with a spouse. You have to take the money out of your own savings account. So something just to be important of, and kind of I'd say an additional accounting wrinkle that the government kind of throws out there for us. The other thing to know is that for those of you that may have inherited a retirement account, there are different rules depending on whether you've inherited the account through a spouse or through a non-spouse. Traditionally, if it's a spousal account, you can actually consolidate that account in your own account, and so you can merge those two accounts, and then the RMDs would start when you turn 73. If the accounts aren't combined, then the RMD schedule is subject to your former partner's age. So something just to be mindful of there. Typically, what we see most folks doing is combining the accounts, but there may be a scenario where that makes more sense for you not to combine them, particularly if there's a large age difference between the two of you. There is a difference, however, with non-spousal accounts, and this is probably the big change in the last decade, is that it used to be that if you inherited an account from a non-spouse, so for example, from a parent, you had the ability to hold on to that account until you needed to take your own RMDs. But now those accounts have to be withdrawn over 10 years. So the government is basically saying, we're shutting a loophole. We really want to make sure that when folks are inheriting these retirement accounts, that money is being withdrawn and taxes are being kind of received by the government. Again, there are some exceptions, but I think for most folks, you'll fall into this category that if you've inherited an IRA, for example, from a parent, that those assets need to be taken out over a fairly short window versus the historical rules. Some of you may remember the day when RMD age was I guess 71, oh, no, 70 and a half. So over the last, let's call it decade, the RMD age has increased pretty significantly from about 70 and a half to this actual next year in 12 months time, it'll be 75. So what the government has been doing here is giving you a little bit more time to accumulate your savings, but at some point the piper has to be paid. So this year it is still 73, but for 2025 that number will jump up to 20, just to age 75 for starting your RMDs. Um, I think what folks probably get a little frustrated about, and I call these like 1% problems to have, because if you're paying RMDs, it means you've saved something, and hopefully, what you've saved, you feel good about kind of funding your retirement. We do get a lot of folks who ask us, how might you reduce your required minimum distributions? And I think, one thing that I would just flag for everyone is that, there is the ability to donate, if you're making any sort of charitable deduction or donation, that you actually can donate the funds directly from your IRA to a charity. And using what's called a qualified charitable donation, those donations can actually count towards your RMDs. So it could be as simple as $100 donation you make every single year to the Red Cross. I would just say don't do that with cash. Fund it directly from your IRA, because it'll count towards your RMD requirement. So that's kind of a nice thing just to think about. You do need to work with the credit union just to make sure that that is done appropriately. The money cannot come to you. It has to go directly from the IRA to the charity. And so just making sure you have that flow set up correctly will be important to making sure it counts as an RMD. The other thing that folks often consider is converting their funds from a traditional IRA, for example, into a Roth. And we'll talk a little bit about when that might or might not make sense in a few minutes. But I want to just kind of flag that particularly the last couple of years, we've seen a lot of folks doing those conversions, particularly when markets fell in the early days post-COVID. Just keeping in mind deadlines, every year you need to make the withdrawals by the end of the calendar year. And again, they're based on the prior year's balances. There are some nuances the first year you make your election, but on an ongoing basis, for example, for this upcoming year, you would look at your 12/31/2024 balances, and the payments would need to be made by 12/31/2025. If you either pay the RMDs late or you miscalculate them, there is a 25% excise tax. That means it's like an absolute dollar amount. So let's say your RMD is $10,000, that would be a $2,500 tax. So that's a pretty hefty penalty. That penalty used to be 50%. It was just reduced to 25%. I think here, what I would just say is the stakes, the cost of getting it wrong are pretty high. And so this is a space where you really want to just make sure that you've marked your calendar to make sure that you pay these, or you withdraw these funds and pay the taxes. So let's talk about Roth conversions, because oftentimes when people are talking about required minimum distributions, the next conversation they want to have is about Roth conversions. And so some of you may be familiar with putting money into a Roth. But a Roth conversion is when you actually take an existing tax deferred account and you convert it into a Roth. When you do that, you actually trigger taxes. So for example, if you have a traditional IRA and you're converting it into a Roth, you trigger the taxes as if you're withdrawing money from your account, even though you're rolling it into a new account. The goal with the Roth conversion is that after you kind of reinvest the capital in the Roth, that it will grow tax-free. And that I think for folks, when they think about, you're 60 years old, living until 90, you think about potentially the tax savings over the next 30 years may be worth it for you. I would just say that there is no one right answer here, because some of the math can be a little bit complicated. It depends on how long you're going to live. It depends on your earnings. And so a couple things to think about, when you consider, like, does a Roth conversion make sense? The first thing I would say is if you're not, eligible to invest in a Roth directly. So many of you may know that there are some income thresholds on Roth IRAs. And so if you are above those income thresholds, a Roth conversion may be, the one way for you to get access to kind of that Roth program. When a conversion can often make sense is if your IRA has losses, and so the conversion doesn't trigger income tax. So for example, if you funded a Roth if you funded your IRA last year, at the beginning of last year, my guess is that IRA, if it was just broadly in the markets, has a gain. Now, it could be that you were cherry picking stocks and had a couple bad picks, and in that case, maybe you had a loss, and you can actually do the conversion without paying any taxes. We saw a lot of that happening in 2020 and 2021 when we saw the big down pull in the market. We saw folks really kind of taking advantage of that opportunity to do these conversions. If the markets have gone up a lot, though, you do need to be mindful that you might be triggering a fairly large tax bill. Folks who think about doing Roth conversions also may be looking at their income and saying, look, my income is lower today than what I expect it to be in the future. And so they're looking to trigger that tax on the Roth conversion when their tax rates are lower, on that conversion. A scenario where that might make sense is, for example, like a year where, let's say, you've just retired. So you don't have income coming in anymore, and maybe you have decided to delay electing Social Security, and so you're in this window where you don't actually have a lot of traditional income coming in. So you might be able to say, well, look, in that particular year, I can do some small Roth conversions because I don't actually have like this base of taxable income that's going to push me into higher brackets. The other time it might make sense is when you want to gift an account to a beneficiary. So it could be, a child as an example, and you may have a specific child in mind where them inheriting a Roth IRA could be interesting. I would say in the past that was very interesting when there wasn't this deadline to take money out of the account. Now that there's this 10-year rule that kind of gifting the account to a beneficiary kind of adds an extra 10 years on your life, but isn't as beneficial as it used to be historically. So a couple things just to really keep in mind, and I would say this is my like health warning on Roth conversions, because I can't look at you all today and say that it absolutely makes sense for everyone. The first thing to really be mindful of is that when you do a Roth conversion, particularly if you're over the age of 65, it does generate income. So that's where the income tax is being charged. It also means that if you're enrolled in Medicare, it can trigger what's called the IRMA surcharge. I'm going to talk about that in a few minutes, but it's basically an extra charge on your Medicare. And so just be mindful that if you're doing Roth conversions, you can trigger this surcharge for Medicare. The second thing to be really thinking about is the 5-year waiting period. You do need to hold on to the funds for 5 years without triggering taxes. It also means that you need to believe you're going to live for 5 years. And so, again, you need to be in a position where you don't need to access those funds for a period of time for a Roth conversion to make sense. And then finally, this 10-year drawdown, again, is kind of, I would say, one of the newer rules, just needing to make sure that, there isn't this kind of old rule of being able to hold on to a Roth forever, which was pretty amazing. That kind of loophole has been closed. And so really making sure that you're not planning based on the old rules, but you're actually planning based on what the rules look like today. All right. So I'm going to talk a little bit about estates and gifting. And I know we've got a couple questions coming in, so I just want to acknowledge that I'm seeing the questions, and we're going to make sure that we answer them as we get closer to the end. So feel free to drop those into the Q&A. So on the estate planning side, I imagine that many of you on the phone already have a will or have done basic estate planning. And what I would just say is that life happens, and it's always important to take another check. I'm in my late 40s, and I have 2 kids who are 10 and 12. And so my estate plan is really about protecting my family and my young kids. But I will tell you that when I'm 65, my children will not be 10 and 12 anymore. And I need to reevaluate my estate plan to really make sure the estate plan is appropriate for my kids' age at that time, for my family situation at that time. And so I think sometimes we kind of do the job once and then we forget that life happens. People grow up, people, kids who were well behaved when they were 10 become those kids you can't kick out of your house in their mid-20s. Things in life happen, and you have to really make sure that the estate plan is kind of up to date. So the first thing I would just say is that kudos to you if you already have a will, but just would encourage you to just take a quick pass and make sure that it's up to date. Really important to make sure you have beneficiaries on your financial accounts. That will keep accounts out of probate. It just simplifies things when you ultimately pass. Important to have a power of attorney so that there is someone who is authorized to take action on your accounts. I will tell you that having my mom passed away a few years ago, and the amount of energy my dad spent on dealing with accounts where they didn't have beneficiaries named and they didn't have an appropriate power of attorney, it elongates the grieving and frankly has folks putting a lot of time on activities that are not particularly happy moments, and add a lot of friction. And so I think we can all get ahead of that by just taking these simple steps early on, to really just make sure that these accounts are easy to work with. We're in a whole new world with what we call digital assets. So just think about passwords. Again, I think about it took my dad over 2 years to get into my mom's iPad. What he wanted is he wanted to get access to some beautiful photos, right? But 2 years of trying to like get into that iPad. So just really being thoughtful about making sure that that information is accessible to the right people. And then finally, healthcare directives, making sure that your desires around healthcare are known and that you have the appropriate documentation in place based on where you live, to allow others to help make those decisions if you're incapacitated. Um, when I think about the will, I think we all know this, but it's always worth saying that it's just really making sure that your hard-earned savings go to the people and places you want them to go to. Um, it is important to know that without a will, the state will determine where your savings go to, and the state may or may not make the decision that you would make. And so, really important just to kind of take that moment. Again, I think everyone on this phone has probably worked really hard to get to where they are. We want to make sure that you control kind of where your assets go in the future. Um, I talked about at the beginning, kind of having a will already and that being enough. But as I mentioned, like life happens, it could be that your marital status has changed. So if you were married before and then now you're divorced, you need a new will. If you were single and you've now gotten married, need a new will. As we talk about changes in adult children's need, I have a family member where them receiving assets outright would likely not be the right outcome. And so really making sure that you've planned for the appropriateness of who might receive money in the future. Maybe there is the joy of new grandkids, making sure that depending on how your will was written, if it is named and has people's names, that you're updating the names, you can also write that language very broadly so that you don't have to go in and make updates every time you have a grandchild. One thing I would just flag is if you've moved, really important to take a look at your will. Different states have different rules, and really important to make sure that your will reflects the rules of the state that you're domiciled in. So for those of you that might be spending time in 2 states during the year, you know which state you're tax domiciled in. That is the state that you need to make sure that your will is up to date in. And on that note, what I kind of just flag here is that, there are, about 9 states that have these community property rules. States like California, Nevada, Arizona, these tend to be states that, have sunshine and a lot of retirees are excited about. The power of attorney, again, you might have put a power of attorney in place. Need to make sure that the power of attorney actually works in the state that you've moved to if you've moved. And so, a lot of things to do, I know, when you move, but just make sure not to forget to kind of take a quick pass back to tidy up kind of any of the state planning documents that you have in place. All right, and then let's then on the estate planning side, again, we've kind of just gone through some of this, but on the kind of where you live piece, just making sure that particularly if you're moving and you're buying a new home, that you've really kind of determined the domicile, that you've got the property titled correctly, needing to make sure that your power of attorney is valid. And then if you have any sort of trust, making sure all that's been updated. So again, I would just say that there's a lot of steps to go to when you're moving to kind of buying a new property, but really making sure that all of these pieces of the puzzle have been tied together. All right. I guess the other thing I would just say is on, I would imagine that most folks on the phone today are not so worried about the broad estate tax kind of aggregate amounts that you can pass on to family, and are probably more likely looking at things, strategies like gifting. I will just say that, the amount that you can gift does adjust on an annual basis, again, with inflation. And so if I take a look today, that gift tax number or the gift amount that you can give on a per person basis is $19,000. If you're married, that means that you and your partner are also together able to give double that amount to an individual. And so just knowing that that is a per person piece. And again, we talked about the qualified charitable donations, just making sure that you know that you can actually give those directly from your IRAs. All right, let's see on the retirement healthcare side. So let's kind of pull all this together. And again, would ask that everyone just make sure you get your questions in. I think for those of you that are either, that are pre-retirement or maybe those that have retired recently, that there's, big transition you make around the age of 65. And I'm going to say around the age of 65 because it depends on whether you're still working or not. But for most people at age 65, where you are transitioning from employer plans, COBRA, ACA into Medicare. I say employer plans, COBRA, and ACA because for a lot of households, you're often using one family member's health care. And when one member goes on to Medicare, oftentimes a spouse will lose their spousal coverage under an employer plan. That's what happened in my parents' case. They had a 5-year age difference. When my dad went on to Medicare at 65, my mom was no longer covered by the employer healthcare plan. And so they needed to spend time really understanding COBRA and ACA as they kind of bought time for 5 years before she was eligible to enroll in Medicare. So on the Medicare side, I know that Medicare can sometimes feel overwhelming. There's a lot of acronyms, a lot of component pieces. When you think about Medicare, what I would just say is know that you need to enroll in most of these different pieces of the puzzle. There are 2 different paths you can ultimately go down, which is a bundled solution called Medicare Advantage or an unbundled solution, which will oftentimes include what's called a Medicare supplement plan. Each of these pieces has a different premium associated with them, and we'll talk in a minute about like what that actually means when we get kind of onto the next page. So when we look at Medicare premiums, the one thing I want to flag to start with is that just keep in mind that premium does not mean cost. Premium is what you're paying on a monthly basis or maybe out-of-pocket costs. When I think about helping folks prepare for retirement and budgeting, I think the one thing that folks often are underestimating is what the cost of their healthcare is going to be. We have an example here of what I would call a fully loaded plan. So this is someone who's enrolling in Parts A and Part B, has a prescription drug plan, and also has bought a Medicare supplement plan. That adds up to about $420 per month and a premium of about $5,000 per month or $5,000 per year. This may not be, if you're over the age of 65, it may not be what you're paying. You may, for example, have chosen a Medicare Advantage plan and maybe have lower premiums, but maybe have the kind of risk of higher out-of-pocket costs. So I would think about these numbers as for folks who want to like fully pay premiums and reduce out-of-pocket costs, and you're kind of paying up front. But again, I think a good number just to be mentally budgeting for, particularly if you're going to have some healthcare needs. So let's go to the next page. So on IRMA, I mentioned earlier that certain activities like rolling over or doing Roth conversions could trigger what's called IRMA. And IRMA is what's called the income-related Medicare adjustment amount. It's an additional charge that's added to your Part B or Part D premiums if your income exceeds a certain threshold. Important to know that the IRMA charge is based on what's called your modified adjusted gross income for the last 2 years. That number includes, for example, your W-2 income. It includes RMDs. It can include proceeds from selling a home. So lots of different ways that you can trigger this IRMA. If you trigger IRMA, then I'm going to show you in a second some of the extra premiums that you will be subject to. I wanted to flag this in this conversation because I think folks are often surprised when they do a Roth conversion that it actually triggers IRMA. And the reality is it's because you're generating income when you do that Roth conversion, it may bump you up into these IRMA brackets. Really important just to think about timing. For example, if you're thinking about doing a Roth conversion and you're thinking about selling a home, you might want to do those in the same years so that if you do those on multiple different years, you're spreading those surcharges out over multiple years. Again, it may not be what makes sense for you based on other decisions you need to make, but just to know that kind of each of these activities can like trigger this surcharge, and each time you do it, you're kind of locking yourself into, frankly, 2 years worth of surcharges. So there's a lot of numbers here, but what I wanted just to show you is what these surcharges look like. And so, for example, on the Medicare Part B premiums, they're $185 per month this year per person. If you're at a bracket where, as a household, you have income of $266,000 to $334,000, that premium is about $370. So it's actually 2 times the standard level. Again, that income level might seem high to you, but I would just remind you that the conversion, a Roth conversion can trigger this. The sale of a home can trigger this. And so it may not be that you're earning traditional income the way you think about it, but there could be other activities that are happening when you move. You sell your home when you buy a new home. Like that activity could bump you into IRMA for a period of time. So something just to be aware of. It isn't a forever thing for most folks. I would say for most folks, it's triggered by the sale of a home, or triggered by inheriting some money, or triggered by doing a Roth conversion. But something that I know from my own father, when he tripped into IRMA, was really frustrating. And so just want to flag that here for all of us today. As we're talking about healthcare, I do want to just pause and just mention again health savings accounts. Just as a reminder, you put your money in tax-free. You do have the ability to get that capital out tax-free in retirement when the funds are used for healthcare expenses. And so this is one of these, I would say, accounts that, particularly when you think about the out-of-pocket costs you may have associated with Medicare, can be particularly helpful to have an HSA available. So when we think about where we are today, and I'm going to wrap up in a second and just answer questions. I wanted to start with some of the big things that I see folks really thinking about when they're trying to really think about the math of retirement. And obviously, part of the math of retirement is how much do you get to keep and how much goes back to the government. The first thing is that Roth conversions can be attractive if you're concerned about managing RMDs. At MSU, the team has a group of financial advisors that can actually sit down and help you think about whether a Roth conversion makes sense. Again, there is no one right answer here, so I wouldn't want you to walk away thinking that we've told you to do a Roth conversion. What I would say is you need to actually sit down with a financial advisor and see if that makes sense. The second thing I would say is that an HSA can really make a big difference on large healthcare bills. And so if you have the ability to put money in an HSA, I would encourage you to do that. And then moving in retirement look, I think when folks are moving in retirement, one of the, typically the reason they're moving is they start with it being like an emotional, you're moving to be closer to grandkids, moving to be closer to sunshine, moving to be closer to family. But would also just flag that moving from a tax and estate perspective can have some pretty significant consequences. It could be positive or negative, and would really just encourage that you're thinking about the financial aspects, particularly from a tax perspective, as you make those kind of moving decisions. So anyway, that is a quick tour. I know we covered a lot of topics, and I know we've had a bunch of questions that are coming in that I'm looking forward to answering. So, Therese, what I would just say is let's start here with some of the questions, and I'm looking forward to answering them.
Sure. All right. So first question that came through was, can you further discuss Roth conversion for, say, a grandchild beneficiary?
Yeah. So again, the idea with the Roth conversion is that you have decided that you have a traditional IRA, for example, and you want to convert it to a Roth. When you do that, the taxes are paid by you because the account is in your name. But you may have decided that account is going to go to a child or a grandchild. And so, for example, in my dad's case, he has put the name of a child on that Roth account that he has. So when you name your beneficiaries, you can actually name the specific child or grandchild or person you want that money to go to. That can also be done via will, but it is much cleaner to do it through the beneficiary paperwork on the account. When you think about passing that to a younger family member, again, they typically have 10 years to pay out the account. I would need to maybe just follow up and just see, because of the age of grandchildren, there may be some exceptions for grandchildren on the kind of the distribution rules. But most folks, when we're looking at it, are thinking about it for an adult child. And in an adult child scenario, you have 10 years to pay out. But as long as, and Teresa, if you can just triple check that we have this individual's email address. We'll just triple
Yes, we
check
do.
based on
Okay.
the grandchild's age, whether they are eligible for any sort of exceptions and what that withdrawal time period is.
Okay, sounds good. So we'll follow up with that person directly. Thank you. All right, and then what recent changes in tax laws should taxpayers be aware of for this filing season?
Yes, the main, I would say, kind of updates kind of from this filing season is just to remember that every year there are these what we call like annual updates that are inflation adjusted. And so just remember that the tax brackets have changed a little bit. So you're able to earn a little bit more in the same tax brackets. We've seen this the standard deduction increases every year based on inflation. And then we've seen in some cases that the contribution amounts that you can make have increased for 401ks and IRAs. All that data is actually in the Silver platform. So when you log on and create your profile, you'll be able to get those numbers.
Perfect. And once again, everybody, that's msufcu.silver.com if you want to go ahead and create that account right away. All right, next question. I moved this year. What additional factors should I take into consideration? I know you kind of touched on this a little bit.
Yeah, so I think, look, maybe I'll just go back here a little bit because I think that's kind of it's a good question and something that I think folks often kind of under plan for. Let's see. Let's go back to where are we? Yeah, I think on kind of on the moving side, what I would say here is just make sure you've been really clear on establishing a domicile. That domicile matters for a lot of different reasons. It matters for like where you pay state tax. It also matters for where you can enroll in Medicare. If you are moving, it also is for those of you that are already enrolled in Medicare, it does create a special election period and it gives you the ability to enroll in a new Medicare plan. But again, it's all about your domicile. So if you are in 2 states during the year, you have to really pick a state. And so be thoughtful about which state you're picking. Again, we do think a lot about property titling. That becomes important if you're switching to a community property state and just really making sure you understand kind of the estate rules in the state you're moving to. Making sure your power of attorney is valid. Not all states follow the uniform power of attorney rules. And so it may be that you're moving to a state where you need to put a new power of attorney in place. And again, this is where kind of just making sure that your trust documentation and your home ownership language has all been up to date to reflect where you live. And so I know there's a lot of things that are going on when you move, but these are some of the kind of, I would just say, like paperwork items that are really important to making sure that the good work you did in the prior state actually works in the state that you're now living in.
Thank you. And then can you explain more about RMD calculations? Are they the same for my spouse and I?
Yeah, so good question on the RMDs, and I'm going to just, sorry for flipping through so many slides, but I'm just going to go back to the RMDs. So again, the RMD calculation, there's a table that on the IRS website that tells you the percentage you need to take out every year. That percentage is likely going to be different for your spouse and you unless you are born the same year. So it is based on your age. And so, for example, my husband and I are 5 years apart. So the first thing that means is that he will start paying RMDs before I pay RMDs. When I turn, in this case, it'll be 75 because the year now next year will be 75. When I turn 75, I will be taking a different percentage out of my account than he will be taking because he will be looking at the table for people age 80 and I look at the table for people age 75. So you do need to run these calculations, I would say individually. So because you're each going to have a different age, and then you also need to run it on your own accounts. And so make sure you don't run like I shouldn't use my percentage on my husband's accounts. I have to run my percentage on RMDs against my accounts. And same thing for my husband. You should be receiving a piece of paperwork, hopefully from MSU, if that's where your IRAs are sitting, that actually does the calculation for you. So you should be getting paperwork every year from your financial provider, whether it's a 401k provider or a financial institution doing the calculation, but it is worth triple checking that the numbers are correct, particularly as we've gone through this phase of the ages changing. Important is to double check those numbers.
Okay, sounds good. And then last question here. What are some actionable steps individuals can take before year end to lower their tax liability?
Yeah, so look, we're at the beginning of the year right now, and so you've got kind of a lot of different time to be kind of thinking about this. What I would just say is when you have time on your side, things you can think about. If you have single stock positions in your accounts, on the taxable side, you can think about what's called tax loss harvesting, which is, thinking about selling some of the stocks that have losses and using that to cover some of the gains on other positions if you are thinking about making changes. Again, this is where a financial advisor can be really helpful and kind of going through that with you. Um, Really thinking about what type of investments you keep in your tax advantage retirement accounts. I always think about, all else equal, I want to have my least tax efficient investments in my retirement accounts and my most tax efficient investments to be in the kind of traditional taxable account. So that would mean like CDs, as an example, anything that's generating income could be sitting in that retirement account because everything is going to be taxed at as income tax in that account. So generally, all else equal, you would hold a stock, as a capital gain asset if given the opportunity. And then finally, for those of you that are considering charitable donations, again, just knowing that, you can, if you're already taking RMDs, that you can now, qualify, I guess, make your donations, but use up some of your RMD obligation. And so, particularly in a household, really thinking about who's writing the check, making sure that it's done correctly with MSU so that you actually kind of get that benefit. And the key thing there again is don't let the money come to you. When you write the check, it has to go directly from MSU FCU to the charity that you're focused on.
Perfect. Yes, very good to know that. All right, so we don't have any other questions coming through. So once again, just thank you for being here with us. These seminars are just always so, provide so much information to our members. And please check out the platform through Silver Retirement Simplified that can give you much more information and plenty of blogs and articles and different calculators on there that can help you to determine some of these numbers that we talked about today. Oh, we did have one more question come through. Sorry. Let me get in here. Can I donate via 401k before RMD time?
You know what, Vicky, I don't know. Why don't we do a little bit of research and I'll come back to you. I want to make sure I
Okay.
give you the right answer. I feel like the rules are very specific to IRAs through these qualified charitable donations. I think it's a very specific carve out. I want to check and see whether the rule allows for 401ks. And so let me just triple check because I know all the age dates have been changing with the RMD dates changing too.
Sounds good. I'll make sure that you have her contact information to get a hold of her. So, okay. So, lastly, just to wrap up here, MSUFCU and Retirement Simplified, powered by Silver, are partnering together to provide you with all of Silver's best-in-class education and tools to validate and improve your retirement plan. So definitely visit msufcu.silver.com to get that started today. We also invite you to reach out to our Truly You Investment Services team, who has financial advisors willing to help you learn more about which retirement options might be best for you. You can schedule a complimentary, no obligation appointment with them by calling our main MSUFCU number, 517-333-2424, and they are at extension 7180 if you wanted to follow up with them about any investment services. Silver will also be joining us again for 2 different sessions in 2025. So we have Tuesday, March 11th, where we will focus on how women can maximize their Social Security retirement benefits. That's another noon seminar. And then on Wednesday, April 9th, we'll be highlighting the platform we talked about today, Retirement Simplified, and just kind of going through a demo of that and showing you all of the great resources that are available there. All right, so I think that's all we have for today. So thanks again for being with us, Rianne. Always appreciate you and all the knowledge that you share with our membership. So thank you very much. There will also be a short survey that will pop up when you close out of the Zoom. So go ahead and take that so we can get your feedback on today's session. And thank you all for being here.
All right. Thank you very much. Happy New Year.
Okay. Thanks, Rianne.
Thank you.
Bye-bye,
Bye.
everyone.